In this tutorial, we are looking at the differences between the four major types of home loan mortgage products in the U.S. Chances are, if you are a home buyer and you're beginning to talk to lenders about your home loan, you're going to land in one of these four options. So what are they? FHA, which stands for Federal Housing Administration, has been around since 1934. VA, which is overseen by the U.S. Department of Veterans Affairs, is a loan for buyers who've served our country. Conventional, overseen by Fannie Mae and Freddie Mac. And USDA, overseen by the U.S. Department of Agriculture. Before we can truly understand these different types of loans, we need to take a step back and get an understanding of how, historically, home loans have been provided and sustained in this country. When a loan is funded, the investment made by the bank is backed by an investor. This means rather than having to wait 30 years to get the original principal balance and owed interest back, the bank can make some immediate money by selling to an investor the right to collect on those interest payments. That investor is in it for the long haul. In other words, another investor buys the debt and the right to collect payments. Why is this important? Because the local bank, mortgage company, or credit union can then profit immediately and return to helping the next home buyer without tying up their money for 15 to 30 years. So how do banks get their money back immediately and continue to provide loans? Historically, what the banks did was reach out to a middleman that bought these loans, thousands upon thousands of them, good loans and bad loans, all mixed up together, and played the role of finding investors for them. Imagine these mortgage loans as red apples, green apples, yellow apples, bad apples, old apples, and organic apples, all mixed up in one bag. The middleman then sliced up that bag into small groups of loans and sold them to end investors all over the world. The middleman, by playing this role, enabled both big and small banks to keep lending money because they had a way to keep replenishing the money they lent. In the U.S., historically, there have been three major companies that either played this middleman role or backed private companies that played that role: Fannie Mae, Freddie Mac, Ginnie Mae. Let's talk about the last one first, Ginnie Mae. Ginnie Mae is actually a government agency within HUD, which backs certain mortgages that are bought and sold all over the world. The end investor who buys these loans, whether in a pension fund in Germany or an insurance company in China, carries less risk because the full faith and credit of the U.S. government is behind these loans as they are resold. The U.S. government is guaranteeing the monthly payments to the holder of the pool of mortgages. What does this mean on the street? How does it affect the home buyer qualifying for a mortgage? Loans backed by Ginnie Mae carry more flexible underwriting guidelines and lower interest rates. Shortly, you'll see which loans are backed by Ginnie Mae and which are not. Unlike Ginnie Mae, Fannie Mae and Freddie Mac, the other two companies playing the role of buying and selling mortgages in bulk, have government oversight and often government intervention, but they are not actual government agencies. The loans they buy and sell are not 100% backed by the U.S. government, and so their standards and guidelines are tighter. So which loans are backed by Ginnie Mae? In other words, for which loans does the government provide a guarantee saying to the end investor, hey, if payments stop coming in, we will step in and make good? The answer: FHA, VA, and USDA. This fact makes those mortgages less risky to the end investors, which in turn means lower interest rates and easier qualifying for the borrowers. Fannie Mae and Freddie Mac dominate conventional loans. But in 2010 and 2011, the government announced Fannie and Freddie will gradually be phased out. This leaves our economy depending on other sources to play that role of providing mortgage money to the banks by packaging pools of mortgages and selling them off to investors all over the world. Now that you've seen how money flows in and out of the mortgage market, let's get into each type of loan. FHA. As we've already said, because the lender has the full backing and guarantee of the government, they can tolerate more risk and allows lower down payments. There are different types of FHA loans, but most common is the FHA 203B, which offers 30-year and 15-year fixed loans. Let's look at the pros and cons of FHA financing. Pros of FHA financing. A down payment of only 3.5%, allowing for 96.5% financing, flexible and forgiving underwriting standards including 2 years since bankruptcy, 3 years since foreclosure, and sometimes just 1 day since short sale. Allows for non-occupant co-borrowers. People that don't plan to live in the property can go on the loan to strengthen the file. Less credit depth accepted. It's not always necessary to have a high FICO score or lots of traditional credit. In fact, alternative or non-traditional credit such as reference letters for your utility bills, car insurance, rent, etc. can take the place of a credit report that lists car payments, credit cards, and student loans. Allows sellers to give closing cost concessions up to 6%. The entire down payment can be gifted. This is in stark contrast to conventional loans, where typically at least the first 5% of the down payment has to come from the buyer's own funds. Certain debts, if deferred, can be omitted from the monthly obligation, such as student loans. Has a streamline feature whereby after 6 timely payments, if market rates have dropped, the present FHA loan can be refinanced without appraisal and with very lean credit qualifying to a lower rate. FHA loans don't require any reserves in the bank, not even $1 over what's needed for down payment and closing costs to close the transaction. Cons of FHA financing. The underwriter can be a lot pickier on the property condition. There are restrictions on buying homes being quickly resold for profit. Mortgage insurance continues for a minimum 5 years, even on a 30-year loan. Has an upfront mortgage insurance and an annual mortgage insurance. In the 9 community property states, Arizona, California, Nevada, Idaho, Louisiana, New Mexico, Texas, Washington, and Wisconsin, the spouse's debts have to be considered when qualifying the buyer, even if the spouse will not go on the loan. This can often lower the amount an individual can qualify for. The loan limits set for counties are typically lower than what's set by Fannie Mae and Freddie Mac in those same counties for conventional loans. FHA cannot be used to finance investment properties or second homes. Now let's look at conventional financing. Interest rates tend to be higher than FHA because even though a government-sponsored enterprise, Fannie or Freddie, backs and buys the loans, it's technically not the government that is guaranteeing them. Therefore, there is a little more risk to the investor. This is reflected in rate adjustments for loan-to-value, loan size, FICO score, occupancy status, and type of property. For example, condo or duplex as opposed to single-family home. Pros: less rigorous property appraisal requirement. No upfront mortgage insurance. Typically higher loan amounts. Spouse's debt doesn't have to be counted against borrower when qualifying. Mortgage insurance can be eliminated if borrowing 80% or less. Some conventional loans like HomePath don't even require an appraisal. Cons: longer waiting times since derogatory events such as bankruptcy or foreclosure. Stricter credit requirements and underwriting guidelines. Typically, borrowers need to have good credit history and high scores. Private mortgage insurance, also known as PMI, is not automatic. There are various PMI companies such as Genworth, MGIC, Radian, and once the conventional underwriter has approved the file, the PMI company itself has to underwrite it before the certificate can be approved. Borrowers with no scores and no traditional credit can typically not be approved and may have to resort to special conventional programs which carry higher rates such as My Community. Less tolerance for high debt ratios. The automated underwriting system frequently calls for the buyer to have a certain number of months of cash reserves. Until the loan-to-value drops to 80%, the seller can only contribute 3% of the purchase price towards buyer's closing costs. VA. VA loans are for those who have or are presently serving in the Armed Forces of the United States. If discharged, the discharge must be something other than dishonorable, as shown on the Veteran Separation Papers known as the DD-214. The Department of Veterans Affairs gives the lender a guarantee up to 25% of the loan amount. This usually means if the home were to foreclose and the lender sold it at 75% of its original value, it would still make out okay because it would recover the other 25% directly from the VA. In order to obtain a loan guaranteed by the Department of VA, the veteran must provide a cert of eligibility, which looks something like this. The certificate of eligibility shows the veteran's entitlement amount, and then a magic formula takes that entitlement and turns it into a maximum loan amount that can be guaranteed up to 100% financing. For example, recently in most counties in California, VA zero-down loans could be completed to $417,000. The VA helps cover the administrative cost of the program by charging a one-time upfront VA funding fee. For first-time users, this was recently 2.15% of the loan amount, and for repeat users as high as 3.3%. Let's talk about the pros and cons of VA financing. Pros. Because, like FHA, VA loans are ultimately backed by none other than the U.S. government, Ginnie Mae, the rates are typically lower and riskier credit profiles are accepted. Veterans with bankruptcies as recent as 2 years and even foreclosures as recent as 2 years can be eligible for VA financing. Buyers can borrow 100% of the purchase price. Seller can pay not only 4% toward customary closing costs, but also another 4% towards concessions, such as paying off veterans' debts to enable him or her to qualify. This adds up to a total of 8% of the purchase price. No cash reserves are needed. The VA can be funded for widows of deceased veterans who never remarried. Veterans without credit scores or traditional credit can be eligible using non-traditional credit. There is no mortgage insurance, even at 100% loan-to-value. Veterans with service-related disabilities can have their VA funding fee waived, thus borrowing exactly 100% of the price of the home, nothing more. Cons. Only veterans or their spouses can be on the loan, no one else. Non-occupant co-borrowers are not allowed. In community property states, spouse's debt, just like with FHA loans, has to be counted and can lower buying power. The property is rigorously inspected by a VA appraiser, often with more scrutiny than conventional appraisals. Sellers may react unfavorably because of the stigma associated with VA loans. USDA. USDA loans are guaranteed by the U.S. Department of Agriculture, giving the lender assurance that the loan is guaranteed up to 90% of the amount of the loan. Since the lender is charged a guarantee fee by the USDA, it passes this on to the borrower, who can have it financed into the loan. For many years, the USDA guarantee fee was 2%. Lenders will lend 100% of the purchase price and sometimes even more than 100% of the purchase price if the appraisal supports a higher value than the contract price between buyer and seller. This last feature makes the USDA loan unique amongst the 4 big loans, since cash-poor buyers can get a break on closing costs if they buy a home even slightly below market value. Pros. 100% financing, 0 down payment. Flexible underwriting guidelines, same as FHA. No cash reserves needed. Seller can pay an unlimited amount in closing costs, unless the amount paid is abnormal for the area or the market the home is in. Even buyers with no score and no traditional credit can be approved. Repairs can be financed up to $10,000. This enables buyers to purchase homes that need a little renovation without having to come up with their own cash for repairs. Income from a second job can be used for qualifying with only a 1-year history of it. The mortgage insurance imposed on USDA loans as of October 2011 is to be declining with each passing year, since it's based on the present loan balance. Cons. Owner-occupied only, and non-occupant co-borrowers not allowed. There are income limitations based on the number of persons in the household and the county the home is in. Geographic restrictions. Only properties in eligible areas can be financed. Check the USDA eligibility map for detailed area maps. All 50 states have eligible areas. After initial underwrite by the lender, the USDA field office has to do a second brief mini underwrite of the file before a conditional commitment can be issued. Sometimes, and not always, this can result in slight delays and longer processing times. Unlike conventional loans, in community property states, spouses' debts need to be counted against borrower, just like for FHA and VA loans. Bankruptcies need to be 3 years old, whereas FHA and VA both allow just 2 years cooling off period after a bankruptcy. Thank you for watching, and be sure to contact the featured real estate professional who provided you with this informative video tutorial.